Learning Objective 3 introduces you to the rules and standards and practices in accounting. We call those rules generally accepted accounting principles, often referred to as GAAP. So when you hear in an accounting class they're referring to GAAP, one, it's going to be in financial accounting. Two, it's generally accepted accounting principles that they're talking about. The interesting part about this is it doesn't really, I'm going to show you this, tell you the story about how this is actually done. It doesn't really talk about that much detail in the book. So I think you might get an idea. So for the most part, you should understand that, and this is financial reporting rules. For the most part, you should understand that accounting is a self-policing profession. Okay. Usually if you're doing financial reporting, you're a CPA, certified public accountant, and you know a lot about accounting. Businesses also change over time, and so there are new businesses that do new things. Transactions are going to happen with those new businesses, and you have to, as an accountant, you got to do the accounting for them. So accountants debate, CPAs debate how things should be handled until they come up with an agreed policy. Now, the committee that actually deals with all of those is called FASB, Financial Accounting Standards Board. It's sort of like a, if you can imagine, a Congress of accountants that are sort of, you know, debating the rules on how things should be managed and how CPAs should be reporting certain things, handling transactions, blah, 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 blah. Once the Financial Accounting Standards Board usually decides on how things should be handled, those rules become part of GAAP. Okay. Now, the government is involved by default because financial reporting rules are overwhelmingly for public companies, right? So, which means that anybody in the public can be a stockholder or a bondholder. So it's one of those things where the government back in the 30s, after the stock market crash, set up a whole bunch of agencies, and one of them was called the Securities and Exchange Commission, and their job was to oversee and apply the laws for the securities market, so the stock market, bond market, mutual funds, things like that. They oversee lots of things like that. And so naturally they have a seat at the table. They're going to want to say, look, well, because we oversee public companies, we also want to have a say with what's happening on how accounting and financial reporting is done. So the SEC is by default part of that discussion process, part of the process in creating the rules that we call GAAP. Okay. Now, GAAP is specific to the United States. Most other countries do not use GAAP. They have a set of accounting rules called IFRS, the International Financial Reporting Standards. As you see here, it's basically the rest of the developed world that follows IFRS. The United States is sort of alone in our adherence to GAAP. There are a lot of similarities. There are a lot of differences. Okay. So it's the International Accounting Standards Board's duty and job to create the International Financial Reporting Standards. Just like it's the Financial Accounting Standards Board's job and duty to create the rules that become part of GAAP. Okay, so it's just the same process, but it's an international process. And it's different than what's happening here in the United States. And I think I had a question from my chat. So if you wanted to go public, do you have to get permission from the SEC? They're part of the approval process. Yes, they're part of the approval process of a public company because the laws that are set up need to be adhered to. Normally speaking, it could be done through the state and the investment banking but they're following the rules that are also part of the federal government. The SEC job is to enforce, make sure those rules are being followed and to enforce those. You probably remember we talked a little bit about Sarbanes-Oxley back in chapter 1 to deal with business ethical issues. Well, Sarbanes-Oxley created the Public Company Accounting Oversight Board as a way to enforce the laws that are part of Sarbanes-Oxley. And so obviously they have a say in things as well. So that's basically, this is what you need to know, GAAP. GAAP is what you need to know. The standards that we must follow. So you just learned about the income statement and like the classified balance sheet. Those are also part of the rules. We have to set things up that way because it's part of the standards that are part of GAAP. Revenues are always first, expenses are always second, right? Net income is determined. Assets have to be classified, liabilities have to be classified. These are all part of the rules of GAAP. So you're learning the rules as you go. You're learning GAAP as you go. So a couple of other types of pieces of information that's just reading information for you. What does the Financial Accounting Standards Board really use when they determine the main qualities of information that become part of the rules? Well, one is something called relevance, which means that we should be accounting for any type of transaction, financial in nature, that would make a difference in a business decision, okay? And so accounting information basically is related to any type of financial transaction that would affect or make a difference in a business decision. And you'll see that when we look at chapter 3 and 4 together. Another quality is called faithful representation, which means that the information that you see is what actually happened. Okay, it's true, it's complete, it's neutral, right? It's not fake info. It's what actually happened. And so when we look at the accounting statements, those should represent what actually happened. Okay, they should not be fabricated or twisted in any particular way. Faithful representation. There's a few other what we call enhancing qualities to accounting information that are assumed. Number one is all companies are using the same principles, which is GAAP. So then if you're all playing by the same rules, you can follow each other's financial statements and financial reporting because they all should be the same. Okay, you're following the same accounting principles. Company to company to company, doesn't really matter what company you are, what industry is. When you look at and sit down and you can read a financial report, it's because they're all following the same rules. The information on those reports can be verifiable. Okay, you should be able to prove the information to a third party. Okay, which is what auditors are basically third parties or independent observers that look and say, okay, yeah, I can see how they got that. The information needs to be clear and concise. That's why there are specific structures to financial statements because of this idea that everything has to be understandable. Companies are consistent when they use these accounting principles. They use the same accounting principles from year to year. And so the information is very, very consistent. And we know how that's happened. And of course, the information that's reported, it happened in the time frame that it's reported in. So all accounting information is timely. There's a few assumptions in how we do financial reporting in the United States. One of the first assumptions is we're all using US dollars. US companies have to use and report their information in US dollars. That's one of the rules for GAAP. And this is important because US companies are, most of them, a lot of them are global, right? They do business in many, many other countries. Well, all those other countries have their own currency, right? So if you're forced to report under the monetary unit assumption, you need to report your information in US dollars. There's a lot of conversion to do. Right? So if you're selling in Europe and you're selling your products in euros, you have to then convert the amount of sales you made in euros to US dollars. You also have to convert your expenses to US dollars, et cetera. So the monetary unit assumption in financial reporting for a US company for GAAP is everyone's using the dollar. Okay. Another one is the economic entity assumption, is that each economic entity is separately identified and accounted for. Okay. And so what if you had, in this case, they show that Ford is its own separate company and should have its records and other things kept separate from another economic entity, which is GM. So that's important. A couple of other ones here. This one you've already seen. You might not be able to pronounce it. The periodicity assumption is very, very important because we also assume that businesses divide their income statements and their retained earnings statements into artificial periods of time. And as you see here, what's listed are quarters and the year, okay, for the full year. And so basically speaking, we're assuming that when we do financial reports, particularly the income statement and the retained earnings statement, they're going to cover that same period of time. And that all companies do reports by the month, by the quarter, and by the year. The shortest period of time of reporting will always be a month. The longest period of time of reporting will always be a year. And that's true for all companies. The last assumption here, going concern, simply means that we are going to assume the company will be existing long in the future. You know, we're just going to assume it's going to keep going on forever. All right, Terrell, what's your question?
If a company and they end their fiscal year in April and it was a bad year, right?
Mm-hmm.
And they do like a hard reset, is their mindset is we have a new budget, let's see that we could make more of our money so that way we could be back in the positive of what we lost in the last fiscal year? You kind of get what I'm saying? Because usually if you end your fiscal year, say December, but you ended it actually in April, it's like, okay, we're gonna start over. Let's see if we could double our money. That way we'll be back in the green.
Well, what we'll learn in chapter 4, I'll introduce right now, and basically that a company can determine its accounting year. A lot of companies will use the calendar year as their accounting year. So 12 months from January the 1st to December 31st, like you and I keep track of the years. But companies also have an option of using any 12-month period of time for accounting records, called the fiscal year, as you mentioned.
Right.
And so as long as they're consistent in doing that, companies are free to choose their 12-month period. Could be calendar, could be fiscal, what have you. Again, the reports are done, the longest they'll do a report based on the periodicity assumption is a 1-year period of time. And they have to keep that record separate from the next period of time. So this is where comparisons work out. They might not have had a good year in the previous year. And so they actually want to do better this year. Well, they have to wait literally for those statements to be produced over the year to compare whether they're doing better or worse. And they can, again, it depends on the company. They can use the calendar year if they want. They can use the fiscal year. Don't get confused about the budgeting pieces that you mentioned are managerial accounting. What we're looking at here, we're not going to look at any budgets in financial accounting. You'll be looking at the financial statements, the income statement, the retained earnings statement, the balance sheet. Those are the statements that we're going to focus on for the financial reporting. Budgeting and other types of, that's a managerial accounting topic that you'll get to in the next class.
Okay.
Okay. All right. Couple of things here. When companies, you're going to look at the balance sheet, you're going to see assets. Companies actually list the asset at the price that they actually paid for it. It doesn't change over time. So if you were part of a large company and they bought a building in 1960 for $1 million in Manhattan, well, that's what it's going to be on the balance sheet for. Even though today it might be worth $100 million, or we don't care what it's worth today. The balance sheet only reports what they actually paid for it, what we call historical cost. Another thing that you're going to see affect the balance sheet is sometimes the value of assets and liabilities might change dramatically, in which case we have to adjust the value of those. That happens periodically, and that's a fair value principle. We never, ever, ever want to list assets or liabilities on the balance sheet in the wrong amounts, in values that are higher than what they're actually worth. Okay, that's fair value. One of the issues that it's very interesting, because it's a principle, remember, generally accepted accounting principles, is how much should a company be telling its owners and the public about what's happening? Well, that's the full disclosure principle. One of the big issues is, all circumstances and events that would make a difference to the users of financial statements should be disclosed, okay? So oftentimes when you're looking at an annual report, what it's interesting to read in an annual report are the lawsuits that are happening, both at the company, because companies sue companies all the time, and other groups sue companies. We're a very litigious society. We love to sue each other, right? So it's interesting to see how many lawsuits companies have against them and who they're suing. And you can actually see portions of that in the annual report. They'll do sort of a summary of it. Well, what if they're about to lose a very, very large lawsuit, but they haven't, it hasn't been decided yet? Should they be disclosing that information? Well, technically speaking, no, because they haven't technically lost it yet. And even if they did lose the first round at trial, they could appeal, which would push off that to a second, to a future date. So that means that companies have to weigh the costs and benefits of what they disclose for information when they do decide what full disclosure means. Should I say I'm going to lose this lawsuit when I actually can appeal it? And appealing means I have a second chance at the lawsuit and I might win, right? So maybe the cost is too high. My stock price might take a hit. My other things might take a hit when it hasn't happened yet. Obviously when it happens, I need to report it. That's full disclosure. But while things are going on, what do I have to report? Well, again, cost benefit, or what we call cost constraint, would be one of the things that companies would be looking at. Okay, and then there's some, vocabulary type of stuff that's listed here afterwards. Okay, where'd you go? Where'd you go? I can't see you. Can you see me?
Yeah, we can see you.
Really? Okay. Well, for some way, shape, or form, you guys